Investors are in a joyous mood witnessing the sharp rally in the stock market on budget day. Bets on rally in stock markets became a hit. And on the other side, experienced investors like Jatin got trapped in the market. Both had listened to the same budget. Then why did some investors make profit while others made a loss? Actually, Jatin Bhai is a long-time investor and invests with a long-term horizon. He had observed such statistics in the budget that would cause headache not only for the market but also for the government. After the budget but before sunrise, many reports too gave weightage to Jatin Bhai's apprehension. These reports highlighted government's huge debt burden and high fiscal deficit. According to budget estimates for the financial year 2021-22, fiscal deficit would be 6.9% of GDP, while the same would be 6.4% of GDP in the next financial year. But market analysts had estimated lower deficit. Out of the 16 lakh crore rupee debt, the government will raise 11 lakh crore rupees will be financed by the issue of bonds. This has upset the market. The market perceives government's not so active stance on fiscal stability to have negative impact on valuation of the stocks and rise in bond yields. Brokerage firms have already increased their targets on 10-year bond yield. UBS Securities has set a target of 7.5% on 10-year bond yield. CLSA has raised the target of 10-year bond yield from 7.25% to 7.50%. On Thursday, Citigroup Inc. withdrew buy advice on government debt. On budget day, bond yield increased to a 2.5-year high of 6.88%. India's not-so-determined bid to list its sovereign bonds on the global bond index only proves this point. The budget did not even mention this. Rise in bond yields has made debt costlier not only for the government but also for the companies which will see higher debt in their balance sheets. This will eventually hurt the valuation of the shares. Foreign investors had sensed this beforehand. Top 500 companies on Nifty have seen gradual decline in FII holding. So, what should investors do? Gaurav Garg, head of research Capital Via, says that investors must keep investing in mutual funds through SIPs. Retail investors can book profits. They can add to their holdings if the market sees 3 to 4% correction. Money9 suggests, there is a lot of uncertainty in the stock and bond market. This is a good opportunity to review your portfolio on the advice of a financial advisor. You can also change your asset allocation. Looking at the valuation of the companies, you can book profit in those shares which are currently trading 100% higher than their 100 or 200 days moving average.